A quiet war is playing out in the global capital markets today. On one side, advanced semiconductor manufacturing is driving a massive secular technology cycle. On the other side, resurgent energy costs are threatening to trigger systemic macro inflation. When ASML reported positive booking signals, tech stocks immediately caught a strong bid. Yet, almost simultaneously, rising oil prices put a firm cap on broader index gains. This classic tug-of-war between high-beta technology and physical commodity assets is creating a massive divergence. Institutional allocators are now forced to make a critical choice. They must balance growth exposure against rising input costs. This structural tension is redefining sector correlations and shaping the next major capital rotation. To understand where the growth engine of this market sits, we have to look at the ultimate gatekeeper of the semiconductor supply chain. ASML holds a virtual monopoly on extreme ultraviolet lithography systems. Without these massive, highly complex machines, manufacturing next-generation microchips is physically impossible. This structural moat gives the company incredible pricing power over its global foundry customers. It acts as a primary toll booth for the entire artificial intelligence revolution. As companies race to build bigger data centers, they must eventually route capital through this single bottleneck. This unique asset positioning creates highly predictable long-term demand. It insulates the business from standard economic downturns. But the digital economy cannot survive without the physical economy that powers it. That brings us to global energy giants like ExxonMobil and Chevron. These supermajors control the upstream assets that dictate global energy costs. Despite the secular transition toward renewable power, hydrocarbons remain the bedrock of industrial productivity. These companies have spent years optimizing their cost structures. They can now generate massive free cash flow even at lower commodity prices. When supply risks emerge, these assets act as an essential portfolio hedge. They provide reliable downside insulation when risk assets face valuation pressure. It is a stark reminder that physical resource constraints still dictate macro conditions. Let's look at the actual numbers to see how this thesis is playing out. ASML's recent booking metrics revealed a significant uptick in advanced tool demand. Net system sales continue to reflect healthy backlog execution. While some legacy segments show signs of cyclical softening, leading-edge demand remains robust. Gross margins have stabilized near the upper bound of management's historical targets. This financial profile demonstrates the resilient nature of deep tech capital expenditure. Foundry customers simply cannot afford to delay their technology transitions. This consistency provides solid earnings visibility in an otherwise volatile corporate landscape. Now compare that growth narrative with the financial profile of the energy sector. ExxonMobil and Chevron have transitioned from aggressive volume growth to capital discipline. Their latest quarterly reports show lower capital expenditures combined with elevated shareholder returns. Operating cash flows remain highly resilient. Even when oil prices fluctuate, these firms maintain high cash return velocities through buybacks and dividends. Their balance sheets are currently cleaner than they have been in a decade. This capital discipline transforms these companies into high-yield cash machines. They offer a stark contrast to high-multiple tech growth companies. Management commentary from the semiconductor space highlights a clear execution strategy. ASML is focusing heavily on expanding its manufacturing capacity to meet late-decade demand. They are managing complex supply chain bottlenecks to shorten delivery times. Meanwhile, technology partners like NVIDIA and TSMC are signaling insatiable demand for high-performance computing hardware. This cooperative ecosystem is focused on maintaining technology leadership. ASML's management is deliberately building a long runway for extreme ultraviolet adoption. They are ensuring that their customer capital expenditure remains committed for years to come. In contrast, energy management teams are singing a very different tune regarding capital allocation. ExxonMobil and Chevron are refusing to chase short-term price spikes with massive production increases. Instead, they are focusing on high-margin, low-cost barrels in basins like the Permian. This strategy prioritizes return on capital employed over raw volume expansion. They are using excess cash flow to pay down debt and secure dividend sustainability. This conservative operational model is designed to withstand prolonged cyclical downturns. It represents a fundamental shift from the debt-fueled growth strategies of the past decade. This brings us to the broader industry context where these two sectors collide. The global macroeconomic environment is currently caught in a complex policy loop. Advanced technology is structurally deflationary. It increases productivity and drives down the cost of computing power. However, rising energy prices act as a direct inflationary counterweight. Higher oil prices increase transport, manufacturing, and data center cooling costs. This macro friction makes it difficult for central banks to ease monetary policy. As long as energy costs remain elevated, interest rates may stay higher for longer. This directly impacts the valuation multiples of growth stocks. We are now witnessing a tactical capital rotation among major institutional players. When technology indicators show extreme bullish sentiment, valuations often become stretched. Sophisticated portfolio managers look for defensive allocation alternatives to manage risk. The energy sector offers a natural hedge against inflation and geopolitical volatility. When oil surges, it provides immediate relative strength to balanced portfolios. This capital rotation helps stabilize broader market indices. It creates a dynamic equilibrium where tech strength and energy gains offset each other. This mechanical relationship is key to understanding modern market structures. However, neither sector is without significant structural risk. For advanced technology, the most critical vulnerability lies in geopolitical trade restrictions. ASML faces ongoing regulatory pressure from Western governments to restrict equipment sales to key Asian markets. These export controls directly threaten a substantial portion of their future order backlog. Additionally, any disruption in the Taiwanese semiconductor hub would halt global hardware production instantly. These systemic supply chain risks are difficult to hedge. They demand a significant risk premium from long-term investors. For the energy sector, the primary headwinds are structural demand destruction and regulatory policy. High energy prices can eventually trigger economic contraction, reducing fuel consumption globally. Furthermore, the global push toward carbon neutrality remains a constant regulatory threat. This pressure increases the cost of compliance and limits access to traditional debt markets. If global economic growth slows significantly, even tight supply cannot prevent oil prices from falling. Investors must weigh these regulatory and cyclical risks against near-term cash generation. Looking forward, a comprehensive valuation reassessment is underway. High-beta technology companies must continuously deliver exceptional earnings growth to justify their premium multiples. Any slight delay in customer spending can lead to severe multiple compression. Conversely, energy companies trade at historically modest valuations. They offer highly attractive free cash flow yields. This makes them highly insulated against sudden market shocks. We are putting several select tech leaders on a breakout watch as their backlog metrics improve. At the same time, we are maintaining a balanced posture by holding disciplined energy exposure. This market environment demands an institutional mindset. Successful portfolio construction requires balancing secular growth against physical macroeconomic hedges. By pairing high-performance technology exposure with disciplined energy assets, investors can construct highly resilient portfolios. That is how sophisticated allocators navigate persistent structural volatility. If you want to stay ahead of these institutional capital rotations, make sure to subscribe to SR Money News. We deliver deep, unbiased structural market analysis to help you protect and grow your capital. Join our community of professional investors and hit the notification bell. We will see you in the next analysis.